last class I was giving you an example of a real company's actual data in terms of the two financial statement. One was their profit and loss statement and another was the balance sheet. The main difference between profit and loss statement and balance sheet, can anyone tell me? The duration part of it. So profit and loss is typically prepared for a specific duration of the project or whatever the time duration you mentioned. The balance sheet is as of a particular date. So balance sheet is more, it accumulates the effect. Whatever happens in several quarters, let's say, will be reflected cumulatively in the balance sheet. The net effect of that will be visible in the balance sheet. But whatever is happening in any given period is essentially captured in the profit and loss statement. Fundamentally, these are again, this is just one major distinction, but then these provide totally different information. And therefore, whosoever is interested in a particular company can look at these accounts to get a more detailed understanding, right? So we had already covered what a profit and loss account example, and I was showing you the balance sheet example. And typically in a balance sheet, the entries are noted in terms of top to down, in terms of their increasing liquidity. So the topmost is the least liquid assets or least liquid liabilities, not least liquid, but essentially long-term liabilities and short-term liabilities. Here the fixed asset and the current assets. So in an increasing order of liquidity, you note down them in the balance sheet. And I was showing you some examples of the liability side. This convention we just used to, like, you report numbers from previous years or previous similar period or all, so that a more detailed comparison can be made by comparing numbers across different periods of time. So we had seen the liability part of it, the share capital, the reserves and surpluses, which is essentially the money that has been put into the company as a capital investment. And the capital investment ultimately needs to be paid back to the investor. So it is shown on the liability side of the balance sheet. That's where we were looking. Then there are some loans, secured and unsecured loans. All these we talked about. Some of these concepts in terms of the balance sheet and the financial statements are kept very summarized, but at the same time more details are available. So typically you use this notation where you make these, call these as a schedules. So if you want to know more information about reserves and surpluses, you can go to Schedule B. And in Schedule B, then you can have a more detailed information on what exactly is happening about this particular type of transactions, right? So that's there. So this is essentially we were looking at. I think this is the slide that I presented last. So fixed assets, you have a total existing assets, the sum of it, the gross means sum. The depreciation part of it, how much of it has been depreciated, so the net value that is available to you. Items awaiting completion or commissioning, this is kind of an inventory which will be required for you to, or which will help you generate money soon, right? So that's also shown here. So the total fixed assets is given here. Investment, if the company has done some investment and the return on that is also shown as the asset side of it, because it's an income that you have gotten out of it. And then there are current assets, which details is provided in Schedule G. Just for this is an example. In that, there you have inventory, you have debtors, you have cash and bank balances and other current assets. So the main criteria for defining what current assets are is the 1 year term. If the asset is liquidifiable, if that is a term, I don't know, or maybe it can be easily liquidated in a given period or a 1 year period, it will be called as a current asset kind of a thing, right? Any doubts in this? This is all pretty easy to understand terms. You see all these very 1 word, 2 word descriptions these are very accounting terms. So you will get familiar once you read couple of problem balance sheets of a company. Does L&T put their balance sheet in public? No? Do you have any idea? Do you have access to L&T's balance sheet? But L&T is not the only company. Of course, there are many companies and you can easily at least go through 1 or 2 examples. I can tell you for sure, for example, the high-speed railway companies in Japan, they have their balance sheets in open in their annual reports you can find. So if you just want to look for examples, you can look for how other different companies have this. Just go through the information in that, right? In this particular case, sometimes only the current assets part. In order to further simplify the information, instead of reporting the current liabilities and current assets, you report something as a net current assets, which is essentially the difference between the current assets and current liabilities, the net part of it, again to further simplify your financial statement. So sometimes that information is also available. Again, this is only done for the current part, not for the long-term part. You never show the long-term assets minus long-term liabilities. That's not the convention. Only for the current assets, because sometimes the information needs to be a little bit more simplified. So all this, I'm just putting it here so that you can have a look at it. But ultimately, if you are following a convention that all liabilities on one side, all assets on one side, then sum of total liabilities will be equal to sum of total assets. If you are following the convention that your current assets or net current assets you are reporting, then sum of all liabilities should be equal to sum of all fixed assets plus net current assets, right? So sometimes those distinctions you can easily see in the numbers that are reported. Okay, this is just an example of a schedule, right? I mentioned that some of these information, if you want more information, you can refer to these schedules, which are again part of the financial statement but separated so that information is presented nicely. So schedule G is only about inventories. So for example, fuel, material in transit, store spares, there you can provide more detailed information about different inventories that you are tracking as a company. And if somebody is interested into really going into those details, they can always find whatever is in this schedule. Typically, these schedules you keep consistent. There is no convention, there is no one standard convention that all inventory will only be reported in schedule G. This can vary, I think, come from company to company. But then over the years, you tend to keep the reporting consistent so that people can get an idea about your reporting norms. If they change over the years, then it becomes difficult to compare the numbers. So that's something that you always have to worry. But sometimes it happens, it's unavoidable because businesses are changing, right? Businesses, they start in different directions to invest and they open up new businesses and all. So accounting practices sometimes have to change. So you have to be careful when you are doing this analysis across the different number of years, is that are the reporting conventions were uniform throughout all these periods that you are comparing. So that you have to make sure. That's a typical error that a lot of people do make, right? In schedule G further, there is something called a work in progress. So work in progress is essentially the uncompleted contracts and the value of the work done, which it will be shown as the asset side because you will receive this money. Because you're talking about the net current assets, so some money you might have already received and all those you have to subtract and show it here. So all these things are just an example. You don't have to memorize all these numbers, but yeah, I'm just giving a detailed example. Okay, I'll finish this part of the lecture again showing through an example how your profit and loss statements and your balance sheets are connected. But then we will go into detail of actually looking at how to make these entries. We will go into detail. First, I'm presenting it just an overview of a solved example, giving you an idea of how the profit and loss statements as well as the balance sheet are connected to each other, right? How to infer. So suppose these set of transactions have been given to you. You purchase material for 7,549 rupees. You paid salaries of 678 rupees, paid telephone charges, interest on the loan paid, income tax you paid. You sold goods for cash of worth 9,959 rupees. You borrowed loan from Citibank. I don't know why Citibank particularly, but yeah, 1,324 by giving machinery as a security. So this was a secured loan, right? We saw that what is secured loan and unsecured loan. And you purchased a machinery of 1,324. So imagine such kind of transactions are given. Of course, this information is not sufficient for you to make the entire balance sheet of a company, because balance sheet would be affected by all the transactions since the beginning. But just for this period, how they are related, I'm going to show you the example. right? So you tend to first make the profit and loss statement, and then you transfer some of those quantities in the profit and loss statements to the balance sheet. That's the typical convention. So in profit and loss, you are mostly interested in how much profit did you make. So you need to essentially record how much was the sales, how much was the costing that you incurred in order to generate those sales, and those kind of numbers will be there, right? Of course, this will be for a given period. I'm not sure what exactly is that. Maybe I mentioned that later, but as an example. So of course, P&L statement have to be for a specific period or a duration of period, right? So in this case, sales is 9,959, which number is given to you. In order to generate that sales, you had to spend 7,549 on materials. You had to spend 678 on staff expenses. You had to spend 928 rupees on administrative expenses, and you need to pay 36 rupees as a, this could be 1000 crores. Don't just treat the 36 rupees. It could be 100 crores, whatever number, but interest you have paid 36. So the total expenditure, if you just add, it's coming out to be 9191, right? So you know your total sales, you know your total cost, so you know your profits. So profit before tax is 768 rupees. Tax applies only on your profit. In case you have not, or you are incurring losses, you are not eligible to pay corporate taxes. That's the part. So then you, let's say, suppose you paid 236 rupees in income tax, that's also given to you. So the profit after tax is 532 rupees. So this is the summary of a P&L statement for this duration. Whatever you did, this is a summary. Now this 532 rupee is something that you gained as a company. So it has affected your balance sheet, right? Can you imagine how? Net effect is 532 rupees cash surplus. So essentially there could be the cash asset of your company has increased by 532 rupees. On the liability side, now this profit ultimately needs to be shared back with the investors. So that 532 will also contribute to the liability side of it, right? All these transactions, internal transactions, all these are also part of, they can change the asset, the balance sheet if you are updating the balance sheet very frequently. For example, sales. Sales is what? 9,959 rupees cash you got, but it led to change in your inventory, right? So all these transactions can have a direct impact also on your balance sheet. But typically what you do is, balance sheet you do not keep on making every day. Balance sheet typically you make at the end of a quarter and things like that. P&L statements are affected by day-to-day transactions, and then the net of them you transfer to the balance sheets. Typically that's the exercise that we do, right? We'll look into more detailed example of this, but essentially this 532 rupees will now reflect in your liabilities as the surplus, because ultimately as a company you need to pay back this money, the profit that you generated, back to your original investors. It's not a money for company to keep. So it also increases your liabilities. Whatever this amount we may have been already given to you. So the total liabilities was, let's say, this 1,856. And on the other hand, you have also increased your cash or bank balance by 532 rupees. So that's also an entry to its assets. So that asset total also comes out to be 1,856. So your total sum of your assets and liabilities is equal at all point of time. Here again, you are just demonstrating minor, cumulative transactions. If you are updating balance sheet every day or after every transaction, we will also see those examples, how will they have an impact on the balance sheet. Okay. Shall we go for detailed examples on how to actually make these entries, how individual transactions affect? Okay. All right. So I have already shown you a lot of examples, but let me now give you a little bit formal but still informal introduction of accounting. Formal, I will show you a little bit details of the procedure, what is the formal procedure, how people do it. But then we will not go into like real nitty-gritty. We will look at, very simplistic examples, and through them, we will try to understand the concept. Because of course, like people who are specialized in accounting, they spend years. I'm not going to cover the entire syllabus of those years in this, especially when I told you that accounting was not my favorite subject. So I'm definitely not going to go into all those details. But let me give you a little bit more details so that you could understand how these transactions are actually affecting. You could argue, why do we need all this information? People who are going to work on site, for sure you will need this information. Essentially, within 2 to 3 years, you will have a visit to your finance section. Most of the project managers have to deal with this on a day-to-day basis. So you will come up with these numbers very quickly when in your professional experience. If you're continuing as civil engineers, I don't know about rest, how long, when we will get the idea. But anyhow, many of you are going to start making personal investments, whatever savings that you are having. And a good investment principle is that you need to see the company, evaluate the company's financial on your own, and you will commonly see these numbers. Even if you're reading somebody's blog post about whether to invest in this company or no, they will also use these numbers to explain you the concept. So if you're not using at a project level, at least I find this information quite useful, at least on the financial, from a personal financial perspective, right? Personal financial management perspective. All right. So accounting is essentially language of business. In a way that, what is the main purpose of language? Communication and consistent communication. Not only communication, consistency, so that whatever I am saying is more or less what you are understanding. I could say gibberish and you could not understand. I will not call that as a language, right? In a way. So that's the part of it, that people are trying to say this, and the people who are interpreting the result are also understanding the same thing. So therefore, language, that's the essential role of a language. You say the same things and you mean the same thing, and people tend to understand. And accounting is essentially that language that helps you understand the financial transactions that happens in the companies. So there is a standard way of reporting. There is a standard way of interpreting these results, more or less. Again, I will reiterate my position. Ultimately, this is a mathematical number, right? What to do with that number is a separate thing. Similar to the projects and the risks and all those things we saw earlier, how to calculate the number is a standard process. What to do with that information, whether do you want to invest in that company based on that information or not, that's up to you. That is not part of the whole thing. That's a perception based game, right? For example, since I'm a fan of Shark Tank, even if the same set of numbers are presented to all 5-6 investors, right? But only a handful of them decides to finally invest, right? So the decision changes even though the same information is being presented. All of them understand whether they like to invest or not. It's a separate issue. Some of them see it as a risky, some of them it is not see as a risky, they don't see it as a personal fit. All those things are a separate issue. But the language is clear. And typically, if your language itself is not clear, then there is no chance that you will get business. Because even in Shark Tank pitches, you will easily see, if you are, as an entrepreneur, if you're not able to tell your numbers in terms of what are your costs, all these are very standard terms. What is the gross margin? What is the net margin? What is your cost of goods sold? Everything is a very standard number and how it is calculated. And everyone in the business understands those numbers. So that's the kind of account, there's the power of accounting and there's a purpose of accounting, right? So in principle, it can be defined as a system of recording, collecting, summarizing, analyzing and presenting information about an organization in the monetary terms. Okay. The findings of the above exercise are usually presented as one of the statements, as we already saw, balance sheets, profit and loss account, or sometime a statement of change in the financial position, which is essentially over the years, as I was explaining to you. Balance sheet over the years, profit and loss statement across different periods so that you can compare. those kind of things. So that is a very standard way to report. And each person could be interested in different numbers presented in those statements, right? As a company investor, you might be looking at different numbers in the same table. As a auditor, you might be looking at different numbers in the same table. As an employee working in the same company, you might be looking at some different numbers and things like that. So depending upon who you are or what your interest is in analyzing that information, you might be interested in different numbers which are reported in that table. Not everyone analyzes every detail using all the information presented in the table, essentially the balance sheets and all, right? So there are interests of owners, there are management of company, there are potential investors, there are financial institutions, there are credit rating agencies, employees themselves, regulatory authorities, and the competitors, right? And you can easily imagine the current owners are mostly interested whether I am generating profit or not, right? So maybe they are interested only in that part of the entire statement. The management of company could be interested in the relative percentage margins, for example, which is like, is my cost of goods sold very high proportion to the profits that are generated, or the proportion to the total sales that am I doing? It could be an indicator of whether I am being efficient in my own management, right? If I have too much cost, it could be also mean that I am not efficient as a company, so I might be interested in that number. Potential investor may analyze the company in a more holistic manner in terms of understanding its entire business, because they have to yet to make a decision of whether to invest in a company. Financial institutions and the credit rating agency. The credit rating agency is like typically a third party system. As I explained to you also in India, now every one of you have a credit rating system. We have a credit score that typically gets billed as you take loans and pay back them on time. You take credit cards and you pay back their bills on time. So that all accumulates to a credit rating. And that's a historical trend of how good you are as a person to lend credit, right? So credit rating agency will also be looking at those numbers. How much loans have you borrowed over time? How much of that loan have you been able to repay over time? How fast, and things like that. And accordingly, they can assign you a credit rating. And credit rating is quite powerful again for other financial institution. For example, if a bank is looking to invest, they might rely, okay, this is a good company which provides credit rating, so I'll just look at their report and see a value about whether to invest in this company or not. Right? For example, Ernst & Young is a financial consultancy firm who does this work. Recently, you might have heard about, what was that company? Hindenburg, right? So that's a global credit rating agency, right? So there are a lot of these things. There's quite a strong business in the world. In general, regulatory authorities are most likely interested in your tax liabilities, right? They are keen on whether you are paying tax sufficiently or not. If your income and the corresponding tax that you are showing, is it matching the norms of a particular country, right? So each stakeholder has something unique to learn about your financial statements. So the information is all present there and you can do the analysis on your own, right? But you can imagine how important it is to make these statements, all these P&L statements as well as the balance sheet. Just showing you again some examples like investors, prospects of investment, tax authorities are more tax liabilities, employees could be looking at company's stability and profitability. I don't know how many employees actually check their company's employer's balance sheet. I never did, but could be. Creditors, analysts, and management I have already shown you. So, in accounting, several assumptions I'll be introducing. Again, to introduce the principle, language has a grammar, right? English language has a grammar, Hindi language has a grammar, Tamil language has a grammar. Grammar is essentially the rules of the language. So, we are going to just talk about some of those basic rules that this accounting language never violates, right? So, the first is the transaction should be recorded from the viewpoint of the person for whom the accounts are maintained, right? So, you need to always fix for whom are you making these accounts. First of all, that has to be 100% clear. A company, when they report the balance sheet, they maintain it from their own perspective. they will not report it from their vendor's perspective. They report from their own perspective, right? And an example of this is, simple example is here. For example, a supplier sells X bags of cement for rupees Y. So on the supplier side, what has happened? The stock of cement bags that existed, it was an asset for supplier because he could generate future revenue on that. There is a depletion in the stock of quantity X, but then there is a sales of quantity Y. The same transaction on the contractor side would look slightly different. The contractor now has X bags of cement in the inventory, which is a form of an asset, right? But they have Y cost or Y expenses in order to acquire these X bags, right? Ultimately, we never do transaction in terms of other quantities. Everything is on the money equivalent. So that's always there. But essentially, this is the case. So depending upon whether you are making accounts for supplier versus contractor, the same transaction will be reported differently. That's what I mean to say. Clear? This part is okay. We have done this before as well. Then there are several other assumptions which are important assumptions. First is that accounting principles assume that the life of a company is infinite. It does not assume that the company is going to get like closed tomorrow or day after tomorrow and things like that. And therefore, this principle of long term and short term is always there. If you are reinvesting right now some of the profit back into the company, ultimately you need to still pay it back, kind of a thing. So there is always an assumption that this company is going to be there forever, right? Then we have covered this part before. All the prospective losses, all the losses that you are going to have in future, but you know for sure that this is going to happen in future, you immediately start reporting them. But the prospective profits are not reflected immediately. They are reflected only when they become accrued. What is accrued? I'll come to that. But we have covered this in the previous example I showed you. And why is it needed? To give a little bit more fairer idea about your real picture. If you know that there is going to be a huge loss, you want to immediately show it on your books. Otherwise, somebody might make an investment and then later they discover that there was a huge loss that is anyhow going to happen. So it basically, and this is, if you do not represent in these numbers, this is actually case of financial fraud. Your company, you could actually go to jail for financial misconduct if you do not report these numbers in this way. So that's the legal part of these numbers as well, right? This concept of sum of debits is always equal to sum of credits. Okay, what exactly is debit, what exactly is credit? I'll come to you. It is not directly or only asset and liabilities, but there is a little bit more complication to it. But essentially, sum of debits is always equal to sum of credits, and this is also called a double accounting principle, in a way that every transaction will have at least two entries, one entry on the debit side, one entry on the credit side. It cannot be that money is getting debited in my account and then credited in somebody else's books. It's not going to happen. If it is getting debited in some form in your account, there is going to be another statement within your company which will have an equivalent credit reported there as well. So sum of debits is always equal to sum of credits for any given firm. It's not talking about across different firms, within a single firm. Okay, how do you ensure that? I will give you the examples later. Then this principle of accrual. Cost and revenues are taken into account or accrued as and when they are incurred or earned, rather than they are actually paid or received. This is the example that I have shown you multiple times. In an online world, especially on the cash on delivery kind of a mode, the moment Amazon sells you the project, immediately that sales is reflected in their balance sheet or whatever financial statements, not when you as a customer actually pay the cash on delivery. So the effect of delivery time is not considered in this. And the same principle happens for even for construction, for everyone else. The moment you know that this is going to happen for sure, you immediately start reflecting it rather than when you actually get paid for the money. Again, this provides a little bit more fairer picture. It does not punishes the company unnecessarily. For example, if you're a company who is working in a lot of credit system, then at least you are saved because you know that this much revenue has definitely come. It will come in a May month or so, whatever, it will come to me for sure, right? And finally, this is a called of principle of consistency in a way that it is important that identical or very similar items must be treated in the same way in different accounting periods and in different set of accounts. If you keep on changing your accounting norms very frequently, people will not be able to compare the numbers and then they cannot make a judgment. Again, this is a principle. You cannot 100% enforce it because, as I told you, business keeps on evolving and accordingly you need to have different things. But you try to maintain consistency across the time periods and across the different type of accounts. I'm saying multiple accounts. I will show you examples of this. There are 6-7 different type of accounts that a company maintains. All those I'm going to show you. Okay. So far with me? So this is a formal accounting process. I will ask questions on this in your main exam in terms of some simple questions on this. This is, I think, on some of those few information that I ask you to memorize in the course. It's again, I will explain you in detail. It's quite logical, but yeah. So this first step of any accounting process is to initiate the transaction. Second is to keep the record of the transaction in a chronological manner. You know what chronological is? Essentially arranged with respect to time at which they have occurred. Then you need to make something called adjustment entries. We will look into more details of each of them. You need to record the transaction in something called a T account, or it's called ledger. You prepare something called an initial trial balance. Okay. Based on this information, you prepare a profit and loss accounts statement, and then you close the T accounts, and then finally you prepare a balance sheet. So your CA is doing all of this for every transaction in their life. So don't underestimate the work that they are doing. Imagine the kind of number of transactions that a company handles. It needs to go through all this formal process in order to make sure that there are no mistakes. What happens is, the most common mistakes people do make when you have not a structured process like this is essentially you tend to aggregate the information. Essentially what you are doing is, from a more granular information, you are finally moving to a more aggregated information. And in that, sometimes mistakes happen. In order to make sure that your mistakes do not happen and each of your aggregated transaction is ultimately, you can cross-check and validate by going into the details, is this process. You can trace it back to the original where the transaction was initiated. So in order to assure that traceability of all financial transaction, this kind of a 7-step process is necessary. Okay. We follow this almost every day, even as a government employees, whenever we are purchasing things, whenever we are buying new equipments, laboratory equipments, machineries and all these things we need to take into account. Of course, computers are there, and computer can, because it's such a standardized practice, a computer can really do this job very fast. Nowadays, AI can do this job really fast in a way because the process has been so standardized, the variability is less. When there's less variability, artificial intelligence also becomes quite efficient in doing all this work, right? We'll not go into training an AI model in this class, but essentially that's possible to do this work through a highly automation. Okay. So the first step, initiation of transaction. Again, example is of construction company, works for any other company. A construction company enters into a number of transactions on a daily basis. Transaction is wherever there's an exchange of money or goods or services or whatever, that's a transaction. The accountants come into the action when transactions take place. No transaction is, however, recorded unless there is a documentary evidence of the same. So maintaining a clear documentary evidence is a legal obligation. It's not that your finance team hates you and therefore they ask bill for 20 rupees golgappa that you ate on site visit. It's the legal obligation, they need to do it. Okay, I know you will have this from airport to there, you took a taxi but you don't have bill, so how can we refund it? You will ask, but then how did I reach to the client location if I did not take taxi and all? Everything will happen. But maintaining the receipts, maintaining the documentary evidence is a legal requirement. Of course, there are very minute, like very small volume. There is always a cap on if there's a certain amount bigger than a particular threshold, you must present. Smaller amount, sometimes you do not track. So that is always dependent. And that also is related to where in the hierarchy of a company you are. If you are at an entry level job, typically that threshold is very low. So you may need to present receipt for even 100 rupees, 200 rupees. If you are at a CEO level, maybe not for that much details, right? But so each company handles all these things differently. Nowadays, you have a lot of apps, which because typically you get an SMS for every transaction that you do. If you are using digital tools, then automatically these things can be made very easily, right? The document could be form of invoice, cash voucher, whatever. There are many forms of what is a legal documentary evidence. The document needs to be preserved for cross-checking the accounts as well as for the auditing purposes. So typically when there's an audit, you will see construction project managers losing their night's sleep because then you need to trace back each of these receipts. Where exactly was this? Where exactly was this? And of course, these days, everything is digital. So you can store the receipts in a digital manner. And typically you are required, I think, 3 or 4 years of worth of data, past transaction, you need to store, and then you can remove them if there are no difficulties in accepting those transactions. With me so far? So second, the first step we have already done is how to initiate the transaction. The second step is to maintain in a chronological manner, right? So the transactions can be cash or non-cash. That's the major distinction at this point of time you make, whether it was a cash based or a non-cash based. For cash, a cash book is maintained. For non-cash, there's something called journal. Not the journal papers that you read, but essentially the journals, like a diary, like it's or in normal day-to-day or small stores, they maintain something called a Bahi Khata. But Bahi Khata is also more formal. Bahi Khata is not, you don't do every transaction in Bahi Khata. There are also Kachi Bahi and Pakki Bahi. Kachi Bahi is like a only rough paper, and then you finally make it in a formal, nice looking yellow pages, red cover book. That's sacrosanct to any business. Don't ever disrespect that book, okay? That's very sacrosanct to any business. But essentially, we have had these as part of our Indian culture also. This is not a foreign accounting principles. We have had these principles even on our ancient systems as well. And this is essentially the name journal derives from the fact that this is the book of first entry. So journals are typically your diary. So diary is something that you note down immediately. Then you transfer it to more formal statements. So that's why the name of diary or the journal comes here, right? In cash book, you need to record all the cash transactions in a chronological manner, and this at the same time you need to show whatever is the remaining cash balance at any point of time. So once you record sufficient number, you close that account, you say that okay, this is the remaining cash balance. Depending on the cash transaction, the nature, it can be either on the debit side, the credit side. What exactly is debit, credit? We will look into it. But essentially, if cash is coming in, could be debit. Cash is going out, could be credit, right? Have you ever received money from any salary or anything, or whenever the amount comes into your account, does it say debit or credit? So, but am I saying wrong? I am saying that when money increases in your account, it says debit. When the money decreases, it says credit. But the SMS you receive from bank, when somebody pays you, it says amount has been credited. Why? So the perspective of from whose the account has been maintained, that's a statement generated from the bank, from the perspective of the bank. From bank's perspective, that transaction is a credit to you. For your personal statement, that's a debit. But that SMS gets generated by the bank, from the bank, for representing their value. That's why it's like a credit message that you get, right? Don't get confused. This is a very, I still remember my nightmares of what exactly is debit and credit, but we'll have a more consistent explanation of what exactly is this. Okay, bear with me. Typically, the cash book entries have a serial number, C1, C2, C3 kind of a thing. And then you use these numbers to ensure the traceability. For example, what you do is, in this 7-step process, each transaction, maybe you could record with some sort of a numbering system, right? Then when you are shifting the information from transaction to this chronological manner, that's where you are assigning a reference number. Then that reference number, you can keep updating in subsequent accounts so that later you can trace the entire link. So you are creating a common code, you could say, that we are calling this C1, and that C1 will represent same information throughout different transactions. So people can easily see where exactly is C1, when did it occur, on what date it occurred, and what is the corresponding account, what are the transaction receipt for that particular document. Okay. So cash book I've shown you, there's something called journal, and even in journal there is a both sides, the debit and the credit sides, and this is usually for non-cash transactions. Okay, for cash transaction you maintain a cash book, for non-cash transactions you maintain a journal, and you have to have the something called a double entry procedure. What double entry procedure means is that there cannot be a transaction with only debit side or with only credit side. Any transaction will have an equivalent debit and credit both. That's the principle you need to assure, so that your sum of debits and credits always match, and therefore if you're not following double accounting, it's also become easier for you to figure out where did the error happen. Then you can know, okay, this is a debit entry, but where is the corresponding credit entry? I am not able to see. So this is where the mismatch is happening, right? So this is the double entry procedure. Again, it's entry within your accounts. It's not about that my account got debited and your account got credited. Within my accounts, one of my account got debited and my other account got credited, kind of a statement is what I'm trying to make. And I'll give you examples of those as well. Okay, but do remember this principle. In general, this is the principle that for every debit there has to be an equal and corresponding credit. And in this particular convention, the debit essentially defines the resources flowing inside the account. Any resource that comes into your account is debit. Any resource that flows out of your account is credit. Okay, this is a easier convention, still creates confusion, at least for me it creates, so I will give you more examples. But this is the basic definition of what a debit and credit looks like. Okay, so yeah, and then debit is returned first, following by the credit side. So left hand side of this journal is typically reserved for debit, right hand side of this journal, no, that's a separate. Essentially you see in the two columns, debit information is first, and then the credit information is also there. And you also have all these procedures in journal entry. Since it's a journal entry, you record the transaction using J1, J2, J3 and whatever the number could be, instead of simply writing 1, 2, right? So for example, date, serial number, account, the debtor account within my old financial account, 3 lakh rupees were debited. Sales account, 3 lakh rupees were credited. So the same transaction have an equal entry in debit and credit. Here what I mean is essentially I got sales of 3 lakh rupees, but that money has not come yet. That money has gone into a debtor. I will get that money back later. So immediately I know that, okay, this transaction was done on a not an immediate payment, but a delayed payment basis, right? These kind of things are very easy to spot in this. Here is the convention. This is the entire accounting community essentially follows these 4 principles. So, if your account type is an asset, what I mean by account type is not like a bank account I'm taking, and the profit and loss and balance sheet are statements. Those are not accounts. The heads within those are called accounts. For example, assets have different type of assets, right? Inventory is an account within the company's financial system. The sales within the company's financial system is called an account, right? So the idea is, if it's an account of asset type, right? Inventory, cash, whatever. If it increases, if a transaction increases the asset, it goes on debit side. If it decreases the asset, it is recorded on credit side. This is clear or not clear? Essentially, asset is what? Cash is coming into the system, increasing, so it goes on the debit side. If cash is going out of the system, it decreases, so it is reported on credit side. With me? The reverse of it is also simple. Liability, if the account we are talking about is a liability type, if it increases, the entry will be reported on the credit side, which is the reverse of the asset side. And if the liability decreases, the entry is put on the debit side. Make sense? Clear? Third one. Third and fourth are a little bit tricky, but we have covered this, not a problem. Expenses. Expenses is essentially your cost that occurred in order to make the money, right? If the expenses increase, it is shown on the debit side. Any idea why? My basic definition is resource flowing in the system is debit. If my expenses is increasing, should it go on debit or credit side? Expenses is resources going out of the system. Increase in them ideally should be on credit side, right? But this is where the perspective comes into the point. Ultimately, if your expenses are increasing, that money is coming from the original investor. Essentially, that money is coming from the original investor. So as a company, you are receiving more money from investor to fulfill those expenses. Got the idea? Suppose you were not a profit-making company. Suppose you were losing money on every product that you sell. It happens in a lot of startups, it happens. In that case, what happens to the company? Every sales that a company makes, whatever losses you made, somebody has to pay them immediately. So as a company, you are getting more money from founders for each time you are making the loss. So your increase on expense for company is more money from the founders, right? So therefore, for company, it's a resource increase, and therefore it is shown on the debit side. Got the idea? Same concept of the equity, owner's equity concept that I introduced, right? It's a bit tricky. I know you will get used to of it. I could not wrap my head around it, but this is how the transactions work. It's easy to understand in a loss-making business, this kind of a convention. Simple. If suppose you sell 100 rupees and on that you make a loss of 10 rupees, where is that 10 rupees coming from? Somebody has to pay that 10 rupees. Either you borrow money from the bank or you borrow money from your investors. So your company's cash is actually increasing because of that transaction, and therefore it is shown on the debit side. Okay? With me, we'll look into more specific examples. It will become clearer and clear. And of course, if you really want to understand more technical terms, you can always look at this link. I cannot understand that language. This is the simplest way I could explain to you. and it works. The convention works more or less. Surprisingly, none of the CA can explain this either because for them it is so deep rooted knowledge. They use it every time. I asked my brother who is a CA, he's like, this is just a convention. What is there to explain in a convention? Because they have been using it for so many times, it doesn't bother them. For me, I was not able to understand why an increase in expense is debit but not credit. I am giving an example of that. So any loss is ultimately fueled by somebody, and therefore as a company you are receiving more input of money because you are making losses to support that, and therefore an increase in expenses goes on the debit side. Same logic, increase in income goes on the credit side because ultimately that income you have to pay back to the original investors. So that income, extra income that you are generating now increases your liability to pay back later. So essentially that is going on the credit side. Make sense? Still not making sense? Bit confusion? We'll look into more examples. It will become clearer. Okay, but yeah, this convention is like 100% you have to follow. Okay, I'll leave here. We'll start the class tomorrow on this topic.